All righty. And as people start hopping in here and just connecting their audios, their videos and stuff. All right. Got a lot of great people on here. Got Adrian, Rick, Jose, Patrio, awesome. Jillian, Shanoa, love this. Lots of great people hopping on board. This is great. Let's see who else is hopping on here too. And I can also just kind of like admit people in as they start popping in as well. But I guess with that being said, how's it going, fam? Mitch here. It's good to see everybody here. Thanks so much for your time. We're going to kick off our series with Ian. I know he did an amazing presentation a bit ago, so I'm really, really happy to have him here. Great pleasure to have you here as well. And so just going on from here on out with Ian and various other just industry professionals, we're going to be doing more of these educational Zoom videos just to educate the community and bring as much value as possible as well. And I know Susie here, who's amazing as well. She is also focused on building a YouTube channel. So let her talk more about that a little bit, and then we'll bring Ian in and go from there.
Yes, we're hopefully Jose and Mitch and I getting together Colorado Gator YouTube channel where we can post this stuff so you can watch it after, find it there, bring other just content to us and have it there to help kind of get ourselves out there, bring more attention to all of us. So
yeah, definitely. I love that. And then we'll talk more about like getting that rolling out as well. And with further ado, let's welcome Ian here, our tax guru specialist that will educate us on how to really just change our lives in the tax realm in real estate as well. So without further ado, let's give it up for Ian.
Awesome. All right. Appreciate that, Mitch and Susie. Of course, thank you guys for setting this up. Thank you for having me on. It's always a pleasure. And Mitch, Susie, you guys have been awesome with just kind of helping people with education and provide value from that piece on various things like tax strategies, investment, strategies and different ways to essentially keep more money in people's pockets and multiply their money faster. And so nice to meet everybody. I'm based out of Miami, Florida. I've been in the financial services space for almost a decade, but I've been specifically focused on tax strategy for the better part of 5 years at this point. Advanced tax strategy is a very, very complex world. There's different tax strategies that real estate investors use. There's different tax strategies that W-2 employees use that don't own real estate. If you have a highly inflated stock portfolio, crypto, different types of RSUs, if you work for a tech company as an example. So there's so many different strategies that are applicable to various individuals depending on what your dynamic looks like. Okay. Everyone has a different dynamic. Some of us are single, no kids, no spouse, making a bunch of money. And, maybe you're in the highest tax bracket or you're up in the 30-something% or more tax bracket. Some of us have families, right? And you're still in a high tax bracket, but God forbid something happens to you. It's like, what does that look like for your spouse? And what does that look like for your children? And so taxes are something we have to worry about when we're alive, right? While we're here on earth, of course, but also when we pass. Because there's things like inheritance tax, estate tax that we don't even really think about. And honestly, lawyers and the government and IRS, they're licking the chops, right? When people get into their 70s and 80s and 90s and have big estates, 10 million, 20, $50 million estates, because they know that once that person passes, if they're not structured properly, well, estate tax right now is at 40%, meaning there's a threshold, right? There's a minimum threshold. And so it's not just, hey, if you pass away with $1 million, 40% is taken away. But currently, the estate tax or inheritance tax, in other words, is at 12.92 million, meaning anything above 12.92 million would be taxed at 40% when you pass. But that's dropping from 12.92 to 7 million in 2026. Okay. And there's even rumors and talks that by the time we get into 2028, 2029, that'll be down to about 2 million. Now, if you're in your 30s, 40s, 50s, 60s, you're looking at 30 years from now, 40 years from now, hopefully longer, when you decide to pass away, right? As they say, well, $1 million, $2 million is not going to really be a whole lot of money. So if inheritance tax is at 2 million and you pass away in your portfolio, your estate as an altogether, a conglomerate was worth 10 million, essentially $8 million of your estate would be taxed at 40%. And that's 40% in today's rate. Canada's estate tax is at 60 something percent, meaning 40% of 8 million, right? So if you guys can do the math, we're talking about 1.6 million would basically be having to, given to the IRS. I'm sorry, not 1.6. It'd be about 4.8 million would be given to the IRS. And that would be owed to the IRS within a very, very short period of time after you passed. No matter if your money was in stocks, crypto, real estate, they would force your family and your beneficiaries to essentially fire sale the property, or they would seize the assets until they got their tax money back. So it's really just a nasty thing. Okay. But with all that negativity and all that bad stuff said, right? There are strategies and ways and different structures that you can use now and set yourself up with to where you will altogether avoid estate tax and where you can minimize your tax liability while you're currently making active and passive revenue while you're alive. Okay. So it's a very, very complex world, but essentially if you're a business owner, W-2 employee, and you have a decent income, right? We're talking a couple $100,000 a year or more, is typically the threshold. Well, more often than not, you do have a tax problem. Okay. My big question to everybody that I work with, especially people that are high income earners, is, are you happy with the amount you pay in taxes? And it's like, who the hell would say yes, right? Who would say yes to that? If you're making $300,000 a year, and let's say you're in the 30% tax bracket, depending on where you live, well, about a third of it, about 90K of it is going to the IRS, even if you're on a W-2. They just take it out of your paycheck, so you don't even see it. There are strategies, even for W-2 employees, that you can essentially get a refund, in that example, of 40, 50K at the end of the year. Okay, if you just structure your income properly. This is all IRS black letter law. This is done by a tax attorney. This is done by a CPA. This is done by a forensic accountant that would essentially keep everything in compliance in regards to the strategy that is implemented within your dynamic. But it's about having the team behind you of experts that'll essentially be able to help you mitigate your tax bill so that you can continue conducting your business, doing whatever it is you do, and not have to go and read the tax code, which is 80,000 pages plus, and I don't think anybody on here has a desire to do so, So with that said, I don't really have a presentation that's put together that's simplified down to the level where I can talk just high level tax strategy. That's kind of in the works. I do have presentations for very specific strategies, but the purpose of this meeting and this call was just to more so to let you know, hey, here's a couple of very, very high level strategies that you can use, whether it's with me, whether it's with your CPA, something you can bring up to your current tax preparer. Hopefully they're willing to work strategies and planning. And it could honestly save you tens of thousands, if not hundreds of thousands of dollars, depending on what your income is. And I mean, that's a heck of a lot of money back in your own pocket. So my favorite saying is, it's not about what you make, it's about what you keep. Okay. You can go out there and make $1 million, but if you're in the 37% tax bracket, if you're in a state with no income tax or no state tax, that's $370,000 that you owe the IRS at the end of the year. So you make $1 million and now you owe $370,000, right? Assuming no deductions. I mean, that is a large chunk of money. And you might be thinking, oh, well, I'll be able to do this and write off and this, that, and the other. You get to the point where you can only depreciate so much. You can only kick the can. You can only defer. You can only deduct so much before you're still left with a multiple hundreds of thousands of dollar tax bill, And so when you get to a certain level of income, right, I would say the threshold is typically about $250,000, $300,000 a year or more. You need more than just a CPA and a tax preparer to file the return. You need a tax strategist. You need a tax planner that's sitting behind you and working in conjunction with your CPA or whoever does your taxes to essentially work strategies as well throughout the year and at the end of the year. If you're not meeting with your CPA at least once every 3 months, they're not doing a good enough job. Okay. And if you're paying over $100,000 in taxes, right, depending on what your income is, they're not doing a good enough job. Okay. And now I know a lot of us have real estate. A lot of us are in real estate and things like that. So you guys are probably familiar and you have probably heard of 1031s, cost segs, advanced depreciation models, things like that, which are great. And I use those all the time. Here's the problem with things like a 1031. It's a deferral of the capital gains tax. It's not an elimination of the tax. You are kicking the can down the road, right? And you're basically now in this specific buy box, right? That's how 1031 works. You have a certain amount of time, the property has to fit a certain criteria, and you buy it. And typically you're purchasing a property that you don't really love, or it's not really a great deal, but you're purchasing it just to avoid the taxes at that time. What you're really doing is you're creating a bigger problem for yourself down the road. So if you're paying $100,000 in capital gains tax today, and you're just like, you know what, I don't want to pay it, kicking a can down the road. Next time you sell a property in 1031, that might be up to 300,000 and then 500,000, then $1 million. And so you look 10, 20, 30 years down the road and you get to the point where you don't want to keep buying properties. You're done. You're retired. You just want to let it. Well, if you want to pull that cash out, you're going to have to pay the capital gains tax. And then, tax rates typically go up over time. Okay. So if you look at history right now, we have some of the lowest tax rates in history over the last 100 years. In the 37% is a top tax bracket. Back in the 50s and 60s, and I challenge all of you to do this after this call, go look at what the tax rates were in the 50s and 60s. They were at 90% plus ordinary income tax. 90% is what people paid in tax. So you made $1, you gave 90 cents to the IRS. And so not to say that they're going to get back up to 90% anytime soon, but we have a tax rate hike in 2026. So as of January 1, 2026, tax rates are going up between 2 and 4% per bracket. Doesn't seem like a lot, but if you're making 300,000, 500,000, $1 million a year and your income starts getting up there, you're talking a decent chunk of money. That could be another property. That could be funding your kids' college if that's what you want to use it for. So the whole reason and the whole point is what I'm trying to say is there are ways to pay little to nothing in taxes legally, leveraging the tax code. Okay. All you need to do is have the right team behind you and basically have the right, have experts behind you who understand the tax code and have actually implemented some of these private letter rulings, which is basically just an in-statement to get, tax code implemented within the federal government, and people that understand it so that they can basically guide you. Right. And all you need to do is go out there, make your money, but keep as much as possible and then put it to work, reinvest it and multiply it. Because if I have a client, as an example, that's making $500,000 a year and he's paying 150,000 of that in taxes, and I'm able to get him a refund of 120 at the end of the year, so I'm putting 120 back in his pocket. Well, one, he was already going to pay that regardless of if I helped him or not, right? Because he owes it to the IRS. But if I'm able to repurpose that money and put it back into his pocket, 120,000, what do you think that's going to do for him? You can repurpose it. You can use it to buy more real estate. You can use it to reinvest back into your business. You can put together a retirement plan for yourself, a legacy plan for your children. I mean, there's so many different things. And I don't think that I've never had a client ever sit there on the other side and tell me, oh, okay, well, you're going to put $120,000 back into my pocket, but it's going to cost me $5,000 to set up as a fee. I've never had a client, hey, wow, I'm spending $5 to save 120. And that's just one example. Okay. It's all relative. Sometimes it costs $1,000. Sometimes it costs $30,000, depending on how complex your portfolio and your situation, is, and what your income is. So one of the strategies that I really, really want to talk about today, and by the way, everybody, we're going to open this up at the end. I won't take the full hour. You can ask tons of questions, take notes, do whatever. I'll leave my contact information in the chat as well so that you guys can reach out to me and shoot me a text. I'm super passionate about this and I love, love, love talking about this. And so if I can just provide any sort of free value, that's a win for me. My company's mission statement is simple. It's to leave people better than I found them, and that's what I live by. And whether that's you doing business with me or us just having a conversation, as long as I left you better than I found you and I provided some sort of value, that's all that matters.
I feel the difference it makes in my life.
All right. Sorry, someone took care of that. Cool. All right, guys. So one of the strategies I want to talk about today, right, which is applicable to real estate specifically, but not only real estate, other facets as well, is something called a CLLC, which is an LLC with charitable intent. So the whole idea behind a leveraged charitable strategy is the client, so the individual such as yourself, would be in partnership in an LLC, a business entity, with a charity. Okay. Now, when it comes to charitable strategies in the tax code, everything has to be very, very, very specific to the T in compliance. Okay. IRS black letter law written in the tax code. and we don't play around and we don't dip into any gray areas. Just want to make that clear. The problem with most CPAs out there, and you guys have probably experienced this yourself, is that they're focused on only compliance. That's all they're focused on, which compliance is obviously important. We're not trying to get anybody in trouble or anything like that. But when you hit a certain level of income, like I mentioned earlier, you need more than just someone to file the returns and someone to just basically go by the books of what they know. Okay. So when it comes to strategies such as the CLLC strategy, all it really is an LLC, which everybody in here is familiar with an LLC, I'm assuming, with charitable intent. So folks such as Mark Zuckerberg and Bezos and all these billionaires, they use a lot of leveraged charitable strategies. Now, some of the strategies they use wouldn't make sense for most of us because we're not making a couple $100 million a year, but we can basically scale it down and do what they're doing on a lot smaller scale, but same concept. So the way a CLLC works, right? LLC with charitable intent, is you as an individual would open up an LLC. The CPA would actually do this for you, right? Because they're the ones that are putting the strategy together. And you would be in partnership with the charity. So the way the structure works is the charity would have 98% of the Class B shares, and you as the individual would have 2% of the Class A shares. Now, the difference between A and B shares basically states who has controlling ownership over the decisions and money and things like that. You have Class A shares, the charity has Class B shares. It's a 98-2 split. But the charity, even though they have 98% ownership over the entity, because they don't have any access to the Class A shares, they have no decision-making authority. They can't tell you what to do with the money. They can't make decisions based on the business, things like that. You are in total control over everything related to the business, okay? But anything you put inside of the CLLC bank account or under the entity, whether that's cash, whether that's stocks, real estate, crypto, collectibles, any sort of asset can be placed in the CLLC. Whatever is placed in the CLLC is an irrevocable gift to the charity. Okay. Now you're probably thinking, why the heck would I do that? Why would I just donate $1 million of cash to a charity, right? Well, let me explain. When you put an asset such as cash into the CLLC bank account, so let's say you're making $1 million a year and you let your income flow into the CLLC. When you move an asset over into the CLLC bank account, it gets an appraisal. It's a third-party appraisal, unrelated to you, unrelated to the tax attorney, unrelated to the charity, completely third-party appraisal. Now, we discount cash at about 86%. Meaning if you put $1 million into the CLLC, it's actually valued in the CLLC at $860,000. Okay, let's use real estate as an example. It's going to make more sense. So a piece of real estate worth $1 million. Say you have no mortgage on it. It's owned outright. It's worth $1 million. You put it into the CLLC, the real estate. So now you're moving your ownership interest of that piece of real estate into the CLLC bank account. That's it. Your ownership interest. Okay. It's appraised at 86% of whatever the value of the property is. So in this example, $860,000 would be the appraised value of that piece of real estate. That's typically what it's appraised at. We don't like to go up to $1 million, and there's a reason why. Now, once the asset is in the CLLC bank or in the CLLC and under that entity, you get an 80% tax credit on any capital gains that are made and sold for that piece of real estate. So example, if you had a property that was worth $1 million and you wanted to sell it, well, the capital gains rate today, tax rate is 20%. So easy math here. You sell a property worth $1 million. Let's say your cost basis was 0, which I know is not realistic, but let's say it was 0 for easy math. You'd pay $200,000 in taxes. 20% of $1 million is $200,000 in capital gains tax. Okay. If you move that asset into the CLLC, the real estate into the CLLC prior to the sale of the asset, you would still be selling it for $1 million, but instead of paying 20% of $1 million, because you moved it into the CLLC and it was appraised at 86%, it's worth $860K in the CLLC. You also get an 80% tax credit towards the sale of the asset. Now, I'm not really good at math. Just kidding, I am. But if you do the math on $860K and you give yourself an 80% tax credit against that amount, 80% of $860,000 is $688,000. So you would get a tax credit because of the structure, because it's a charitable LLC, a tax credit of $688,000 as soon as you sell the asset. Now, $688,000 tax credit and the actual sale of the asset would be taxed at 2% capital gains instead of 20%. Because remember what I said a little bit ago. The structure is you own 2% of the entity, the charity owns 98% of the entity. So if you only have 2% ownership and you've donated the asset to the charity, the $1 million piece of real estate, you also pay capital gains tax on 2% of the sale. So you would basically pay 2% of the 200,000, which is $4,000. So by doing this, you're saving 200,000 minus 4,000, you're saving $196,000 in capital gains tax. Okay. Now, I hope everyone's following, but we can, we can answer questions. Put your questions in the chat if you have them, and we'll go through them at the end. But remember, you're paying 2% capital gains tax now down from 20. Okay. So here's how this works. So you have $1 million now sitting in this bank account because you sold the property, right? Sold it for $1 million minus the $4,000 you had to pay in tax. So you have $996,000 in the bank account. Now you're like, all right, Ian, I want to take that money out. I donated the asset to the charity, but I need that money. So there's strategies out there like trust, charitable remainder trusts. If you've ever heard of a CRUT, which is a charitable remainder trust, it has the same concept behind it of what I'm explaining. The problem is the money is restricted. You cannot pull the money out easily out of a trust. Once it's donated, it's pretty much gone. So like, why the heck would you do that? Sure, you get the tax savings, but you don't have the money. With the LLC structure that I'm referencing, you have to collateralize any asset you put in the CLLC 1-for-1, at least 1-for-1. Okay. Which means if you put $1 million asset in the CLLC, you need at least $1 million of collateral to back that up. Well, the cheapest form of collateral in the world today is permanent life insurance. So part of the structure is you having a life insurance policy with a death benefit that would match whatever the assets are in the CLLC, at least. We typically do a 2.5 to 1 multiple. So if you have $1 million asset in the CLLC, we'd get you $2.5 million worth of life insurance coverage because we want a little bit of a buffer there. The only purpose of the life insurance is so that you could do a swap with the life insurance and the cash in the CLLC bank account and get that money paid out to you in your personal bank account. Okay. Now I know that was like drinking from a fire hydrant. So let me rewind. Okay. If you move an asset that's worth $1 million, we're using a piece of real estate as an example, into the CLLC, and you sell it, and now you have that sitting as a cash position in the bank account, and you want to take that money out, or you want to take a portion of it out, or you want to reinvest it, whatever you want to do with it. Well, if you want to take that money out of the CLLC bank account in order to access it, because remember, when you donate it to the CLLC, it's an irrevocable gift to the charity. Irrevocable means it's gone. You can't get it back. It's now the charity's, 98% of it. But we're collateralizing it with permanent value life insurance, at least the same amount. So we would need at least $1 million policy to basically collateralize the amount of asset, the dollar amount of asset you have in the charity. Now, per the IRS tax code, and this is the compliance piece to it, you are allowed to do a swap with the death benefit from the life insurance policy and the assets, the cash in the CLLC bank account, and essentially pull out that money tax-free and put it into your personal bank account. You could have $1 million of cash sitting in the CLLC bank account on Monday, and you can do a swap and it generates a loan document. This is all what the forensic accountant, the CPA, and the tax attorney work this piece. And you can have the $1 million in cash sitting in your personal bank account on Tuesday. It's that quick. It's not a process. It's just a transfer. That's all it is. And then at the end of the year, every time you've done a transfer, what the CPA and the tax attorney and your team of tax professionals does is they generate a loan document reflecting the swap between the assets in the CLLC and the amount of life insurance coverage you have. And that's how it works. If you know anything about life insurance, if you borrow from a life insurance policy or you borrow against it, it's tax-free. It's completely tax-free, which is why, one of the reasons why we use life insurance as a form of collateral. Also, in that example, a $2.5 million life insurance policy might cost you 20 grand a year. in premium. But who cares that you have to pay for the life insurance policy because you're saving $196,000 in taxes. So you would still net 176 if you're accounting for the fee that you have to pay for the life insurance premium. You need the life insurance premium to access the money in the bank account. If you do not have the collateral in place, then you cannot access the funds. It would not be in compliance, and that would be a red flag with the tax code. Okay? Now, that's the structure, and that is the reason why a CLLC is used for tax strategy, and basically to take your tax liability down from whatever it is to 2%. The only restriction to using the CLLC is it cannot be used for active income. Okay? Meaning, and there's a caveat to that, but you can't just, put make $1 million and put the full $1 million into the CLLC and then get only pay 2% in tax, right? If it's rental income, that's considered passive. You can do that. But if it's active income, like from a job, you can't do that. Now, if you're a W-2 employee, as an example, and you're making $1 million a year, I'm using that as a number because it's easy math, making $1 million a year as a W-2 employee, and you want a deduction in your taxes, well, some CPAs might say you're a W-2 employee, there is no tax strategy for you. That's not true. As a W-2 employee, you can get up to a 60% reduction in your AGI by using the CLLC strategy. Up to 60%. That's all. You can't go over that. So if you're a W-2 employee and you're making $1 million a year, you're in the highest tax bracket, obviously, right? So let's say you live in a state, whatever, and that's 40%. The tax bracket is 40% for you because you're making $1 million. So you would basically get taken out in a W-2, $400,000 of your paycheck every year would be taken out in taxes, 40% of $1 million. If you implement the CLLC strategy and your money, your paychecks basically pass through the CLLC bank account, right? And then you transfer it over to your personal account, you can do that. Well, you get a 60% reduction in your AGI, which means instead of being taxed on $1 million, you're taxed on $400,000 of income at the end of the year. Not only does it lower your tax bracket from 40% probably down to 35%, so you're saving money there, but you're not paying taxes on $1 million anymore. You're paying taxes as if you made $400K because you get a $600,000 60% reduction in your adjusted gross income. That's what AGI stands for. So just that alone, think about it, right? Let's assume you're still paying 40% in tax at $400K. Well, 40% of $400,000 is $160,000. 40% of $1 million is $400,000. The difference between $400,000 and $160,000 is $240,000. So at the end of the year, you would get it, or when you file your taxes, you would get a refund check for $240K. That would be a refund. Simply by having a CLLC strategy and structure in place. And that's how a W-2 employee saves money on taxes. Now, the CLLC strategy is not the only thing a W-2 employee can use. We can do things like tax credits, depreciation credits. There's other strategies as well if this is something that you're not comfortable with, which is fine. But that's how you get a massive reduction in your active income, active revenue. Passive revenue, you only pay 2% in tax. Active revenue, you get a 60% reduction in your adjusted gross income, meaning you're only paying 60% of the taxes that you owe. And the rest is coming through as a refund. So imagine if you're sitting there and you actually are making $1 million a year and you're just used to paying $400K in tax, $400K. Maybe it's a little less because your CPA is throwing some standard deductions in there, whatever, right? Maybe you bought some real estate, you're paying $350 this year. Okay, cool. But imagine being able to put an extra $240,000 back in your pocket at the end of the year by setting something like this up. I mean, that's life-changing even for someone making $1 million a year. Because the things you can do with the 240, I mean, right? Like we don't even have to get into it. We don't have to talk about that. Like, I mean, you could fund a retirement plan for yourself, and in 5 years you could basically retire. Just in that example. So that is the CLLC strategy in a nutshell. Okay, that's a very 30,000-foot view. It's not applicable, and it does not make sense for everybody. I want to make that clear. It doesn't make sense for everybody. It just doesn't. But if you are a higher income earner, right, typically I'd say $250,000, $300,000 or more a year, and you pay close to $100,000 in taxes, this could significantly reduce that tax liability Or if you're a business owner, if you own real estate, if you own a 401k, something that's highly appreciated and has basically inflated by a lot, and you're facing a large capital gains tax, by placing the asset or the business or the crypto account, whatever it is, by placing the asset inside of the CLLC prior to the sale, you get basically an 80% reduction in the capital gains tax. So instead of paying 20% of the full amount, you're paying 20% of 20%. Because you get an 80% credit towards the tax that's owed. Okay. So that's another way to put money in your pocket. And then once the money's in the bank account, again, you can get it right back out because you can do a swap with the life insurance, which acts as the collateral in this example. You don't have to use life insurance, but it only makes sense to use something as a form of collateral that basically virtually costs you nothing to set up. Life insurance, again, the reason we use life insurance is not for the life insurance. We use life insurance because you can get a super high death benefit for essentially pennies on the dollar. And guess what? If you don't qualify for the life insurance, let's say you're older, let's say you have health issues, anyone in your direct lineage, a child, a grandchild, a sister, a brother, anybody that's in your direct lineage could be the insured on the life insurance policy, which means that the cost of the insurance, the amount of premium you have to pay for it, is lower because it's less costly to insure a 20-year-old who's healthy versus a 70-year-old who has health issues in that example. So there's ways where we can, structure that if, let's say, life insurance is not something that you would basically qualify for from that standpoint. Okay. So that's the CLLC strategy, right? That's one of my favorite ones for real estate people. That's one of my favorite ones for people that are exiting a business that have a huge capital gain. People that have like RSUs. RSUs are basically like stock options from a company. If you work for a company that gives you stock options, anything that basically you're going to have to pay a large capital gain on. I'd say if the capital gain is over $100,000 or more, something like this might make sense for you. It might. And as far as income goes, if it's passive income like revenue, like rental income, well, that's taxed at 2%. So if you're making $100,000,
We'll be back.
if you're making
We're gonna go somewhere else, man. Why are you buying this shit, bro?
Adrian is
This ain't no outfit.
Adrian, please.
Sorry
All
about
right,
that.
appreciate that, Mitch. Yeah, so again, so that's active passive revenue, such as rental income, is taxed at 2%. So if you're making $100,000 a year in rental income, you pay taxes on 2%, $2,000. And then active revenue, again, active revenue cannot be taxed at 2% only. There's a reduction in your adjusted gross income, which is 60%. So instead of paying taxes on the full amount of whatever you make, you're basically getting a 60% discount. And that's the structure. Okay. So that's a CLLC, and that's kind of, very, very top level how it works, how it is. And I have things like calculators. I have things like different software that, we could essentially put a scenario in and say, hey, this is what you're selling, or this is what your income is, and this is what you pay in taxes now. And if you implement something like the CLLC, this is what you would pay in taxes. This is what it costs to set up. This is what the premium is for the life insurance. Does it make sense for you or does it not? And it's a simple formula. It's a simple formula. But again, it's not applicable to everybody. If you have just 1 year where you made a whole bunch of money and then you're going back and you're going to make a regular $50,000 income as an example, it doesn't make sense to set up. But if it's going to be something where you have a huge appreciation, or you have a rental portfolio that highly appreciated real estate or any sort of assets, or your income is just high, you're a high income earner, something like this would definitely make sense. Okay. And this is one strategy. Now, I want to touch on two basic strategies that can also be used if something like this is not applicable in your scenario. If anyone on here has heard of tax credits or know how tax credits work, tax credits can also make a huge difference for someone who's kind of in a bind and like, hey, it's the end of the year like it is now. We're already at Thanksgiving basically. And you only got a couple weeks left to kind of implement some last minute strategies. So if let's say you got, $100,000 tax liability at the end of the year, that's what you owe the IRS. You can do something like purchase a tax credit, solar tax credit, energy tax credit, retirement tax. There's different tax credits that are available, right? But you can purchase a tax credit for essentially 85 cents on the dollar. So what that means is if you owed the IRS $100,000 at the end of the year, in order for that to be a wash, you would need $100,000 in tax credits because that would basically zero out your balance, right? So if you owed 100,000, but you purchased 100,000 in tax credits, you would now owe the IRS zero because you got a credit of 100,000. For 85 cents on the dollar, what that part means is it would cost you 85K to purchase $100,000 worth of tax credits. So if you do the math on that, you're getting a 15% discount on your taxes. That's it. That could be implemented in 2 or 3 business days. It's not as good as the CLLC in this example, but think about it. You were going to have to pay 100,000 to the IRS. That's it. And if you buy tax credits, instead of paying 100, you're paying 85. I mean, it's simple. 15% discount. That's one example. There's also depreciation credits, which we can do, something more like 60 cents on the dollar. The problem with a depreciation credit is that the depreciation credit is you can only use them up to a certain amount. You have to qualify. There's a little bit more of a stringent process, but the idea behind it is you're just basically taking someone else or another business entity's depreciation and you're reducing your taxable income by X amount, 40% as an example, because you're purchasing their depreciation. So if someone has a big real estate portfolio, like big real estate portfolio, we're talking hundreds of millions, billions of dollars, they would basically be able to sell off their depreciation credits. This is all done through the government and through the IRS and blah, blah, blah. But they would sell their part of the depreciation credits because they don't need them. They don't need them. And then people like us can go and buy those depreciation credits and then get a reduction in our taxes. So it's just another strategy. But again, if I were to go to you and I said, hey, Jose, look, you're going to pay $100,000 this year to the IRS. Okay. That's it. If you buy tax credits for 85 cents on the dollar, there's solar tax credits as an example, instead of paying 100, now you owe 85. There's no fee there's nothing else to it. It's as simple as that. That's how tax credits work. And so if you are really in a bind, or if there's just a little bit left over at the end of the year and you just want it, like, let's say, you owed another 10 grand, 20 grand, 50 grand, and you couldn't get your liability down that low, there's another 15% discount for you. And look, I have access to about $255 million in tax credits right now. They pretty much renew every year because once those tax credits for that specific project or that specific piece of entity or company or whatever it is, usually cities sell tax credits. So there's a city, Gardenia, California, right now that purchased a bunch of like hydrogen type plants or whatever in their city. They got $200 million in tax credits basically for doing so. They don't need the tax credits, so they're selling them to people, regular people like us. You would go through a CPA and a tax attorney to purchase the tax credits. You don't just walk up there and say, hey, can I have a tax credit? No, you do it through a CPA who has a relationship with someone that basically manages and owns the tax credits. But that's how tax credits work. So it's a nice last minute play. It's a nice strategy to use. It's very, very simple, right? You're purchasing them for 85 cents on the dollar, 80 cents on the dollar, 90 cents on the dollar. They vary. And you're just basically getting a discount on whatever you owe to the IRS. That's it. So simple strategy, not as into the weeds as the CLLC as an example, but it can be useful. I mean, who's not going to take a 15% discount in that example? So tax credits are also a good strategy and one that I like to implement. And then there's some other strategies out there, right? If you're extremely advanced and things like that, but for the purpose of this call, I don't really need to get into that. I just wanted to really bring up and touch on the LLC with charitable intent. I have tons of information. I have PowerPoint. I have a video that explains things like that if you guys reach out to me, I'd be more than happy to share with you, be more than happy to get on another call and answer questions you have, specifically related to maybe your scenario, just to see if it makes sense. And pretty much the last thing, again, I'll say and I'll touch on is, it's not for everybody, okay? If you have a small capital gain and you're only going to make a little bit of money or whatever, it just doesn't really make sense because it does cost money to set something like this up and you have to pay for the insurance and things like that. But if you are consistently making earning a high income, and if you're or you have a portfolio that with highly appreciated assets in it, you should absolutely look into this because, again, it doesn't hurt. And worst case scenario, it just doesn't make sense for you. Maybe you just go buy some tax credits, So to wrap this up, I've been doing this for quite some time. I've been in the financial services industry, like I said, for almost a decade. I got a lot of experience. And the way my business is structured is I'm structured like a virtual family office. So when you have access when you communicate with me and you basically work with me or you need guidance or whatever it is, you have access to CPAs, forensic accountants, tax attorneys, other tax professionals, even RIAs if you want your money to be managed by like a financial advisor. We have partnerships and alliances with all these folks who would basically be doing all of the background work, And if you want to keep your CPA or if you have someone who already does your taxes and things like that, by all means, you can stay with them. That's not a problem. They would just communicate with our CPA for a specific strategy or a specific set of documents that would be provided to them at the end of the year when your taxes are filed. And that's kind of how that would work. So with that said, got about 15 minutes left. I know I talked a lot, I spoke a lot, and you guys are probably tired of hearing my voice, but I hope that there was at least a little bit of information that each of you took and learned something new today. And by all means, at this point, we can open the floor up to any questions that you have. I'd be more than happy to answer them. And if we don't get to everybody, I'm going to put my information in the chat as well, my phone number and my email. Shoot me a text, send me an email. Schedule a time to chat with me, and we can definitely get your questions answered.
Yeah, that was freaking amazing. Thank you so much, Ian.
Of course, absolutely. Thank you, Mitch. Appreciate
Of
it.
course. Yeah, it looks like I got some questions in here with Monica
Yep,
as well.
I'm here. I know I put it in the chat, but I thought I would just ask you, and thank you, Ian.
Of course.
I am not at that place yet, but this is really good to know because I will get to that place. When you talk about like putting the money into the CLC before a sale, how long does it have to be in that CLC? Is there like a season period before you do the sale?
1 day before.
Wow. Okay.
1 day
That's
before.
really cool.
Now the CLLC, one thing to answer your question, Monica, one thing to keep in mind is the actual strategy itself, right? Doing all the filings, like the CPA and the tax attorney have to submit documentation and they have to do like, IRS filings. That does take 3-4 weeks to actually set up. So if you're going to sell your property next week, you have to set the CLLC up first, which does take 3 or 4 weeks. But once it's set up, you can place the asset, your ownership interest of the asset inside the CLLC and then sell it tomorrow and you get the 80% tax credit.
Okay. Very good. Thank you.
Of course.
Along the same lines of that, what if the real estate's already in a different LLC? Is it easy enough to put it into a CLLC?
Yep,
Or
absolutely.
it'll
So
take
you're
3 to 4 weeks.
so you're not actually moving the asset into the LLC. You're moving your ownership interest of the asset into the CLLC. So let's say you have Sesame Street LLC that owns this piece of real estate, okay, in your example. What you would do is if you were 100% owner of that, you would move your ownership interest, so Sesame Street LLC, into the CLLC. So now the CLLC would own Sesame Street LLC, which owns the asset, which owns the real estate. So once it's sold through the CLLC because if the asset is under the CLLC, and that's when the tax credit comes into play. So you're not actually moving the asset in there. If your ownership interest is through an LLC, through a trust, through another business, you would just move your ownership interest, whether that's personal or something else, into the CLLC, not the actual asset itself. Does that answer your question?
Yes, absolutely. Thank you.
Yep, no problem. I'm gonna also put my Calendly in here as well. Look, I know guys, guys and gals, it was a lot of information. I mean, this is a lot to wrap your head around for sure. I tried to keep it as simple as possible, but seriously, if you want like, hey, look, you're curious, someone, whatever. I mean, taxes are they're inevitable. And you probably heard the saying, the two things that are for sure that are guaranteed in life are death and taxes. And so that's hee hee ha ha, right? We laugh about that, but billionaires, people that make a lot of money, they don't pay taxes. It's not because they're doing anything illegal. It's not because of that. They just have a team of experts behind them who understand the tax code. And it's as simple as that. So if you have a CPA, that's fine. But once you hit a certain threshold, you need more than a CPA. You need more than someone to file your taxes. And that's it. And and it doesn't mean you have to meet with someone once a week to talk about your tax strategy, right? But quarterly, semi-annually, maybe even monthly, you got to meet with a tax strategist or just have someone to kind of lean on for information so that, hey, them and your CPA and whoever else you have behind you that's kind of managing that piece of your portfolio, I mean, they would be able to work together and you'll put a lot of money back in your pocket. And most of us on here are like, yeah, taxes suck. I mean, they do. Taxes freaking suck. We pay taxes on our income, and then we pay sales tax. And then if you're a business owner, you have to pay taxes on the revenue you make. And it's just a vicious cycle, and property taxes and all the other stuff, right? So if there's ways where you can leverage the tax code legally and you just have a team of experts to lean on and then guide you through it, I mean, why would you not do that? You know, and it's not like you have to spend tens and twenties of thousands of dollars to do this. It's, most of the time I've had so many conversations and meetings with people where I just tell, hey, look, you're in a bind right now. It's almost December. You got $100,000 in taxes that you owe. Go buy some tax credits. Here's the information to a CPA who will assist you with that. That's it. That's it. And again, it's a 15% discount on your taxes. I mean, so all it is just knowing the right people to talk to and being in the right circles. And you guys just being on this call tonight, obviously you're proactive about it, but there's no reason why anyone should pay more in taxes than what they need to. And the tax code is designed so people are paying, whatever bracket they're in. But if you just look into it a little bit and you just have a few extra conversations, you can literally save hundreds of thousands, millions of dollars in taxes over the course of your lifetime. So that's what I have to say on that. All right, we have another question here, Doug. I'm going to read it out loud. How is a charitable LLC defined by the IRS? Are there actions that have to take place to prove it's a charity? Great question, Doug. You're not allowed to just go pick any charity you want. That's not how this works. Okay. There are strategies out there where people can be, hey, so like, let's say, I'm going to pick on you, Jacob. So let's say Jacob wants to go open up a CLLC and say, oh, I'm going to open up Jacob's Charity for dogs, right? That's not how this works. There are specific charities and donor advised funds that have gone through the vetting process over a 20, 30, 40-year period that this strategy has been around, and with the CPAs and the IRS, they've gone through a vetting process and they know exactly what this structure entails and what it looks like. They know their role in this. You don't just go out there and pick a random charity. Okay. These charities are pre-vetted and you have the option to pick between maybe 6 or 7 of them. That's it. You have to go with one of those charities. If you pick your own charity and the IRS, they're going to audit you. They're going to look in. There's going to be potential. They might think it's collusion or something like that. That's a big no-no. People do that all the time. But if someone says they open up their own charity, they open up their own organization, 501c3, and they go and get tax write-off, absolutely not. That is way too in the gray, and maybe they don't get caught. I hope no one, but that's asking for trouble. So to answer your question, Doug, there are actions to take place. Yeah, these charities have been vetted by the CPAs who implement the strategies, the tax attorneys, and they are explicitly stated in the private letter rulings that the IRS has, in regards to the CLLC strategy. So it's not just any charity. And I think the other part was, how is a charitable LLC defined by the IRS? It's really just an LLC with charitable intent. And again, the ownership interest, the 98% of the entity, the LLC that the charity owns, is one of those 7 charities. It has to be one of those 7 charities, and you would be the other 2% owner. And that's how that structure works. So yeah, and by the way, so if something like this is like, oh, you were like looking into it or whatever, there are quarterly and monthly compliance checks that the CPA and the tax attorney and the forensic accountant do with each client. So if you became a client and you had this strategy implemented for yourself, you're not just like, hey, good luck, go figure it out. Good, that's not how this works. It is, you're not required to retain the CPA services for filing your taxes. Like I said, you can use your own CPA. But in terms of the documentation and all that other stuff, that is all done by the CPA and the tax attorney. You're not just out there on a whim. You're not just guessing and thinking, oh, I think I need this form. And I think, Every quarter and every month, there is a compliance check. The CPA is dotting their I's and crossing their T's and making sure you have enough collateral. They're making sure you're not spending money out of the bank, the CLLC bank account. You're transferring it to your personal first, things like that. So it's very hard to mess it up, especially if the tax attorney and the forensic accountant are the ones managing everything. Monica, you have another question? Or was that, see your hand is raised?
If nobody else has any other questions, I actually have a question regarding taxes, but different topic.
Yeah, of course, absolutely. Ask away.
So I am considering doing a Roth conversion, just taking money from my traditional, converting it to the Roth, and
Yep.
I want to do like 100,000. But is there any strategies to reduce that taxes?
Yep, we have something that can get you. I do Roth conversions very, very often with like old 401ks, 403bs, IRAs, things like that. And you can essentially get a 40% discount on your taxes if you do the Roth conversion properly. So, Roth conversion is fine, but again, first of all, good on you for thinking about this, converting it to Roth, because the sooner the better. But instead of paying, whatever the ordinary income, whatever your tax bracket is, because it's taxed as ordinary income when you do the conversion, well, we could get you a 40% discount. It's just a strategy. It's done over a period of time. And so if you owed, 30,000 in taxes, you would only pay 40% of that or 60% of that number. So absolutely, you should do the Roth conversion, but let's have a conversation so I can at least give you some guidance on, hey, like this is how you can get a 40% discount on that,
Awesome. Thank you.
Yeah, of course. Mitch, I know you asked how many tax strategies are there? Thousands of tax strategies. And I don't purport to know all of them. I definitely don't know all of them. But if there's a tax strategy that you heard of, or if there's a tax strategy that you want to know more about, I promise you that I have enough connections and people in my network, and I've been doing this for long enough to where I know someone that will be able to explain more or help you out with it, or whatever, answer questions that you may have about it. So thousands of tax strategies. The tax code is 88,000 pages. That's how many pages are in the tax code. No one's read them all. No one on, maybe, I don't know, maybe some weird person out there has read them all, some CPAs, nerd CPA, but I haven't read it all. And again, it's about deciphering the information. It's about basically simplifying the information into strategies like the CLLC or tax credits or Roth conversions, and basically helping the public understand, hey, person that makes money, hey, person with money in a qualified retirement account, stop, don't pay the normal amount in taxes. That's what the IRS wants you to do. Talk to someone who understands strategy and planning and things like that, and ask the questions before making a decision or before making a big move. And you should be having meetings at least once a quarter with someone who can guide you in terms of taxes. If you're making, like I said, the threshold I would say is about 200, 250 a year. If that's your income, if you're higher than that, you need tax strategy. Or if you have any assets that are appreciated by a decent amount, 20, 30, 40, 50% or more in appreciation, you should be talking to someone who's a strategist before selling the asset or before the year ends and before you have to pay taxes. And don't wait until the last minute. Don't do what everybody else does and wait until October, November, December to start talking about, oh, what can I do this year? That's silly, because with tax credits and things like that, there's not an unlimited amount always, and you might not be able to get access to the tax credits that you want access to, that are going to get you the biggest discount if you wait too long and you wait until December 30th to do so. And seriously, guys, one last thing I'll say is, if a CPA tells you to buy a G-Wagon, or if a CPA tells you, don't do that. Unless you really needed to buy a car or a truck or whatever for your business, that's one thing, and taking the depreciation is fine. But I have clients who are making $800,000, $900,000 a year, and their CPA says, hey, go buy 4 or 5 G-Wagons this year as a deduction. And I'm like, really? And it's a serious conversation. Go buy a couple G-Wagons for the write-off. That is not a tax strategy. That's not. And why are you going to buy something that depreciates by 60% as soon as you drive it off? It just, again, if you need the vehicle, or let's say you wanted whatever, that's one thing. I'm not telling you not to buy one. And of course, take the depreciation, but don't use that as a strategy. If you see something on TikTok, buying your car in Montana to save on sales tax, all this, Guys, those are like, that's like a TikTok, like online strategy. There's a right way to do it, but please ask a professional before just going and buying a car and putting a Montana license plate on it and not paying the sales tax. Okay. It's not worth the IRS auditing you. And then now they're digging into everything, and then you have to deal with that headache. Okay. And by the way, don't be scared of the IRS. Okay. They're just doing their job. Don't be scared of them. If you play the rules properly and you use their code, the IRS tax code, and you have a team behind you that knows it and is using black letter law, I mean, you don't have anything to worry about. And if there was ever an audit or anything like that, you should have a team behind you more than a CPA, a forensic accountant, things like that, a tax attorney that can help you out and walk you through it. I mean, audits happen. It is what it is, but there should never be any reason why anybody fails an audit. And even if you did fail an audit, you would probably just have to owe more money or something like that. But we don't want anybody to fail an audit in the first place, or even get to the point where they have eyes on, red flags on them from the IRS. So those are my 2 cents, and that's kind of what I have to say. So I appreciate everybody being on. If nobody has any more questions, feel free. If you think of anything, I put my phone number and my email in the chat. Reach out to me. That's my personal cell phone number. I'm a pretty quick texter. I'd be more than happy to get on a phone call with you, and I can send you my calendar link as well, and we can schedule a time to chat at any point. So thanks so much, guys, for having me on. I hope you all learned something.
Yes. Thank you so much for your time indeed, and looking forward to the next one. So Susan and I will be talking with Ian about the next Zoom with more strategies and more opportunities just to give back to the community as well. But yes, thanks again, Ian, and everybody else who is on this call this evening. Thank you so much. Looking forward to the next one.
Awesome. Bye, everybody. Good night.
Dan.
Thanks, Ian.
See you guys.
That guy.